The Principal Residence Exemption can be a very powerful tax tool. It allows you to eliminate capital gains tax, which could run into the tens, if not hundreds of thousands of dollars, when you dispose of a property. But if you own more than one property, which one do you designate as your principal residence to get those benefits? Nicole Ewing, Director of Tax and Estate Planning at TD Wealth, joins me now with some things to think about and some really interesting things. We're talking about houseboats, Nicole. Houseboats sort of thing. Okay, so let's just remind people first off the basics of when it comes to a principal residence exemption.
Right. So you do need to own the property. You can own it jointly with a spouse or another person, but there's only one principal residence exemption per family unit. You must ordinarily inhabit that property. That doesn't mean live there full time, but it does mean occupying it as a home. You may have another property you spend more time at, but this is what you regard as your principal residence. You can use that. There's a definition in Section 54 of the Income Tax Act for principal residence, and it's much broader than you might think. It includes homes, apartments, condominiums, of course, but it also includes trailers and houseboats, as we mentioned, and it can extend to property outside of Canada as well. Now, in order to designate your property as a principal residence, you must complete it. You must complete the tax form. So that's your Schedule 3, claim the disposition on the form. That's your capital gains, and then complete Form 2091, essentially designating this property as your principal residence exemption. And be mindful as well about the property flipping rules. Those are those new rules that say if you dispose of a property that you've held for less than 365 consecutive days, it will be treated as business income and not a capital gain. Of course, there's exceptions to that as well. So marriages, marriage breakdowns, illness, moving for work, those sorts of things. But otherwise, those property flipping rules are going to prevent you from accessing that principal residence exemption in that first year.
Got it. Okay, good to know. Now, let's say someone is in a position where they do own more than one property. Let's just say, for argument's sake, it is a house and a cottage. So how do you decide which one of those should get that principal residence treatment?
Well, both of them, we need to do the test, the analysis on each property. So if both of them meet all of the prerequisites in order to be a principal residence exemption, then it comes down to a question of math. We're going to look at what our average gain is over the years that we've owned that property. So we'll look at our fair market value, the proceeds of disposition, subtract the cost base from that. That's going to be your gain, and we'll divide that by the number of years that we've held the property. And to the extent one of them has a higher average gain than the other, that's probably the one that you're going to prefer.
Got it. Okay. What about the new capital gains rules that have come in? I mean, how do the rules factor into that same decision?
So there's no limit to the principal residence exemption. So whether it's a $10 gain or a $10 million gain, the full gain can be sheltered from tax, provided it meets the rules of the principal residence exemption. But if it doesn't meet those rules, then we do want to take into consideration that new threshold, where if we realize gains for less than $250,000, we'll have a 50% inclusion rate. Any proceeds over that, so anything over $250,000, will be subject to a 2/3 inclusion rate. So if we can do things where we have the opportunity to sell a portion one year and sell the remainder the next year, or perhaps utilize our capital gains reserve rules in the Income Tax Act that allows you to spread the realization of that gain over multiple years, to allow us to maximize our $250,000 threshold, their annual threshold over multiple years as well.
Okay. What about if I change my mind? I mean, what if something happens in my life where, okay, I was going to designate this one as my principal residence, and then, something happens, and maybe you can give me an example when that might happen. Can you do that?
Well, you can choose which years you want the exemption to apply to which property. And ultimately, you're going to be, again, looking at that average gain over the number of years that you've owned the property. So let's say we owned one property for 15 years and the other one for 10. The first 5 years, of course, only what that first property is going to take the entire principal residence exemption. Then we have two properties that both qualify for a 10-year period, and we're going to do the analysis of what is the average capital gain per year that we've earned. Now, there's a rule called the +1 rule. And this essentially allows you it compensates for when you buy and sell a property in the same year. But if we have one property that has a higher average gain per year, we don't have to claim it for the full 10 years that we've owned it. we can claim 9 years, and this +1 rule allows you to shelter the 10 years of gain, and that would leave 1 year +1. So we'd have 2 years of sheltering for that additional property. So essentially 11 years of sheltering for the property that the 2 properties you've owned for 10 years. It's a bit of a math equation, but we need to be careful here as well that we don't have some missteps if we are selling to family members for less than fair market value. It doesn't really matter from our principal residence exemption, but it will impact their cost base. Carrying that property forward could increase their future taxes. If we are renting out a portion of our property during any of those years, we'd want to be mindful of if we've done a structural change or if we've claimed the capital cost allowance, we're not going to be able to use our principal residence exemption for that property. So we want to make sure if throughout the years we're doing things like a change of use or renting that property or deemed dispositions where we've added an owner and essentially disposed of an interest in that property, that we're making the appropriate elections and filing the appropriate forms to make sure that we're able to maximize these rules to our advantage.
Yeah, I was going to say, make sure, yeah, the key one is talk to someone who actually can help you, that knows the rules, and not even just the rules, understands how it applies to you and your life and actually what you're trying to do.
Oh, yeah, absolutely. These are pretty complex, right? This is the Income Tax Act that we're dealing with, and there's forms that need to be completed in a particular way. So working with your tax advisor to help you understand how it applies to you and your circumstances, and then working with your investment and financial advisors as well, who might be able to give you a little bit of insight into how these sorts of decisions impact the rest of your financial picture, and whether that's going to influence some of the sales decisions or the exemption decisions that you're making.
All right, Nicole, always a pleasure. Thanks so much.
Oh, my pleasure, Kim.